Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwi Bank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Welcome back to another week, another episode of Markets, Mystics and Mayhem. We've recently just had the Reserve Bank's November monetary policy statement. It was the last time we'd hear from the Reserve Bank for 2025, so definitely a lot on the table. But as expected, we got a 25 basis point cut. The cash rate is ending 2025 at 2.25. That is quite fitting. I actually just realised that. But, you know, it was a very interesting meeting because we've had, 375 basis points of rate cuts. I'm getting all my 25s and 75s mixed up. But, you know, and it was last meeting for Christian Hawkesby.
Yeah.
And, you know, let's just get into it. What was your take on the meeting? It was what we expected, but there were a couple of maybe hawkish tints to some of the commentary, some of the OCR tracks, and even a little bit of a vote in there.
Yeah, there was something for everyone, for sure. You know, the main message is that interest rates have been cut again. We've seen the cash rate drop from 5.5, which was very restrictive, very painful, caused a recession, all the way down to 2.25. Took a little longer than we would have liked, but we've at least reached a point where we can say monetary policy is stimulatory, interest rates are low enough that they should be attracting investors back into the market. They should be helping out businesses across Aotearoa. So the good news is that interest rates have been cut and they're down at a level which is stimulatory.
But I think this meeting we just had, it could have been a very easy one and it could have just been it come and gone like that. But like you said, the decision itself was expected, but the micro reaction that followed in the days after signaled that it was a much more hawkish meeting, right?
Oh, absolutely. I mean, I think the way they played it yet again, they came out hawkish to market expectations, which didn't really help the cause, right? You saw a 25 basis point rate cut in the cash rate, but wholesale rates lifted 28 to 30 basis points, right? So kind of reversing that good work that was done. So what the market has gone from is expecting further rate cuts to actually now starting to price in the risk of rate hikes in the second half of next year. So that's that, you know, that big shift. But for me, the good news is that we can come out and say this should be the low in interest rates. And I think that's why markets have reacted the way they have.
Yeah, because going into the meeting, markets kind of like us, we had sort of said, there's about maybe a 50-50 chance of a further cut in February. And we thought based on that, the Reserve Bank would use their OCR track, you know, their forecast of the cash rate and maybe put that, you know, with a terminal bottom rate of 2.15 to kind of indicate that 50-50 chance. But we didn't actually see that. We saw, you know, the terminal rate ending at 2.20, which still leaves the door open for the Reserve Bank in case they need to come back in and cut. But it is kind of looking, you know, didn't quite meet market expectations. So in that sense, it was seen quite hawkish. And then you had the vote as well, 5-1 with one member voting to keep the cash rate unchanged.
So on the track, the RBNZ'S one of, I think, 2 central banks globally who actually put out a forecast for their cash rate. And they use it to give guidance as to where they think the risks are. And like you said, they only said 5 basis point chance of a cut near term. So 5 out of 25, that's not a massive probability. In fact, it's just there as almost a nod to the downside risks. We thought they were going to sort of be sort of 2.15. If they wanted to be dovish, you could go 2.10. The market just read that and went, okay, you know, rate cuts are done.
He kind of signalled it as well in the press conference, saying that the track is consistent with the cash rate being on hold for most of next year. The risk, as we say, the track being where it is. near term, the risk is still that the cash rate it goes down rather than up. But they seemed very upbeat. I think really confident about the economy going forward, which is good news. We wanted this turnaround, but we probably would have been more confident in saying the economy is in a good place maybe after summer, right? Because we were saying the summer is a period where we watch these green shoots that we're starting to see, whether they actually are sustained over summer. We probably would have come out more confident next year when we see a bit more evidence of this, right?
Yeah, February for us was the more important meeting, but they seem to have baked it all into this meeting. And what did the vote tell us compared to the last time they voted?
It's completely different. Last time they voted was it for 2 saying 50?
50.
Yeah. So I mean, and then before that they voted as well, and it was very different. So I guess this is just reflective of a turning point where things are starting to change and you just don't know where things are going. So I think this is common and at a turning point.
So this vote was for on hold though, right? So you had one person voting for on hold. So I think you're right. When you reach that sort of turning point, you have a few people disagreeing, and we might see more of that next year, particularly if everything goes really well and rate hikes are the next thing. I think there'll be a few votes
as well
for that before they happen.
Yeah.
So it's definitely something to watch.
Yeah.
So you say they're upbeat. What were the forecasts and flavour like?
I guess, it wasn't actually too different. That whole output gap, which is where they determine where medium-term inflation will land, they see that narrowing over the medium term. So things are starting, it's basically the economy growing a bit more and closing that gap, and inflation should be following in the medium term. So their forecasts weren't actually too different. They're still expecting this recovery to start over the second half and then gain some momentum in 2026. Labour market looks like it's stabilizing. It just seemed like they were more confident in the recovery in 2026, probably because policy settings are much more stimulatory now as they were compared to last year.
Yeah.
So they're just more confident in the outlook. There's still, risks in what's happening overseas. You can't discount that, but locally things should be improving.
And I think they've gained some confidence in talking to businesses. There was a box in there about talking to businesses, and when I asked the Reserve Bank, how much of this shift is because of what the businesses have said, in the write-up they said that the feedback from businesses was similar to July. I'm like, well, how can that be the case? Because you've given a 50 basis point rate cut in October, and you're telling me that means nothing. But what they didn't say was that they were more certain in the recovery. They're not, businesses weren't upbeat, but they were at least
not worse.
Not worse.
So they're probably not feeling
stabilizing.
They're not feeling very good right now, but they're more confident in the future in 2026.
Yeah,
right? Okay.
Yeah. They're more confident that the quicksand that they've been in for the last 2 years isn't getting deeper.
Yeah,
they still haven't got their knees out. They're still struggling. But yeah.
We're really scratchy for some good news then if we're just saying that that's enough to be upbeat, that people aren't feeling anything worse.
Well, I guess from a Reserve Bank's point of view, what are you responding to? Are you responding to things getting worse? Yeah, I think they have been, right? Yeah. So the fact that things are stabilising suggests that, maybe you are getting interest rates to a level that are working. And then I guess next year you're kind of hoping that stability, turns into a recovery.
I guess they're just also being cautious, wanting to see how, I think 30% of the mortgage book is meant to roll off in the next 6 months. They probably want to see some of that play out. Obviously, you don't want to leave it too late, because if you're waiting for that to happen and it's still not been enough, then you're a bit late already.
True.
And that's kind of been maybe their downfall in previous decisions.
It's been the story the last 2 years.
Yeah. But, I kind of understand a little bit of the caution in terms of being like, yeah, this is maybe it. But also, I don't know, there was still some lines, like I think, the now former Governor, Christian Hawkesby, coming out the next day saying, the hurdle for further interest rate cuts is high from here, and, you can't expect to be cutting forever. And I get it. Like, I'm hoping this is the end, but also there's just a little feeling in the back of my head, little voice being like, oh, but what if the summer doesn't play out and you've just destroyed that momentum of, these lower rates coming through because people now think it's the end. But yeah, I guess the reaction in markets kind of tells you that as well, though.
Yeah. Yeah. I mean, it goes back to your point that we would have been more comfortable waiting until February before, almost announcing the end of rate cuts, right? Just gives you that extra 3 months to get some data and digest it and see how well the summer period really is doing. How well was Black Friday received, and there's relentless advertising at the moment, which to me just points to retailers still doing it really tough out there.
Yeah, you'd want to wait till February to just be more confident in the data showing that turnaround, but also to keep market pricing, or at least markets quite stable, because as we said, there was a big sell-off in rates the day after, right? So on the day they delivered that 25 basis point cut, we're a little bit more hawkish than expected. Interest rates, wholesale interest rates were up around 10 basis points at 2-year swap.
Yeah.
But it was a day after, that Thursday, and all this data that came out, that we really saw the big move.
Yeah.
Right?
And that followed, what was it, the Aussie inflation data, retail sales here, which was really strong, and you guys looked at that in detail. What were the other things? There was a couple of other...
Some business and consumer.
That's right.
Yeah.
Some other banks' business.
Yeah, we won't name them.
You don't bother looking at that rubbish.
Just the headline that it's up to the highest in 11 years.
Business confidence.
Business confidence.
That's important. And it is a good survey, I'm not joking.
It is good, but it follows. So it was business confidence for November. It obviously followed that 50 basis point cut in October.
Exactly.
And there was kind of promise for more cuts. So you just wonder how December what the business confidence will look like.
Yeah. If we were running the Reserve Bank, we would have delivered a very similar message, but we wouldn't have been silly enough to remove the chance of a further rate cut. We would have just left it in there for a few months. It doesn't hurt anyone. And what it does is it keeps wholesale rates down. Exactly. So if you'd come out with an OCR track of 215, not 220, it's not a big difference.
5 basis points.
The market would not have moved. The market would have gone, okay, there's still a near 50-50 chance of another cut in February. And it just would have held those wholesale rates lower, which meant that we as banks would have just been able to pass on a little bit more, I think, to mortgage rates and business lending rates. But what you've done is you've cut with the one hand and you've increased, you've tightened financial conditions with the other. So again, they're far from perfect, and they keep playing this weird game of being hawkish, dovish. So, I mean, there's seasonality in the New Zealand
and it's November
economy, and here we are with the seasonality in the RBNZ.
Yeah.
So if you're silly. If you're new here, November tends to be quite a hawkish meeting, and then February tends to be quite dovish. So come back in February. Because they got it wrong
in November.
Yeah.
Yep. And so then May's
hawkish again. And then August.
Should we continue?
And then August is dovish.
And
it's
August
just one on,
dovish.
one off.
Yeah.
And then the NPRs is just somewhere in between.
Yeah. So the economy's doing this, and the RBNZ'S going either side of it, up and down, up and down, up and down. I guess it makes our jobs interesting.
Yeah, it keeps us on our toes.
Well, they're wrong both ways.
But, again, let's just stress 28 basis points of an increase in the 2-year swap is huge in just a couple days, right? It takes you back to September, which, like you say, erases kind of the 75 basis points of cuts that they had delivered in that time. And so it's just, that's not what what we were expecting going into this meeting at all.
No, definitely not.
Thought it'd be like a straight bat, which be enough to just keep things stable over the summer, because that's what you really wanted, just a stable period over a long break over summer, and then come back and reassess.
And they can't sit there saying, well, we didn't expect, such a big move, because they speak to financial market participants, banks, before, and they ask, if we say this and do this, what's the market likely to do? So, they would have been told, if you only deliver a 5 basis point cut in your OCR track, the market's going to take that as being quite hawkish. So it just strikes me as, another weird kind of move. You cut with one hand and you let the market take off with the other. It's bizarre. Unfortunately, it sort of undoes a little bit of their work. But I think, we kind of move on from that and think, well, is the economy recovering? What are we seeing now in our transactional data, and what happened to the retail sales? Is there a glimmer of hope there?
It seems like it. That's the thing. The data that followed kind of indicated that view that things are turning around. So it was just a really strong combo of kind of a hawkish Reserve Bank and then really strong data. I think that retail sales number up, what is it, almost 2%?
Almost 2%, which was 3 times what was expected by market.
Yeah.
Which, it's pretty chunky. And then, you can strip out some of the volatile parts of spending and look at core spending, and over the quarter it was still up 1
So what are you stripping out when you do that?
For retail sales, it's motor vehicles, so like your cars, things like that, and also your fuel. But you strip that out, and your core retail is up 1.2% over the quarter as well. And it's getting a bit more broad-based in nature too. Almost just over half the sort of measured industries recorded an increase. A lot of the move did come from your sort of electronic goods. I think they were up almost 10%.
I'd love to know what the discounting is.
Well, the like price deflators shown, I think it's its third consecutive fall. So there's definitely some discounting going on there, and it's obviously working. It's getting electronic goods into people's shopping baskets. So that's good. Cars were pretty strong, but that's kind of one of the more volatile. We kind of stripped that out. But even then, that core showed that it was pretty good. And I think something that was really encouraging was that in terms of across the regions, spending has sort of evened out a little bit. Because last quarter we were seeing that spending was definitely increasing, but it was really concentrated to the South Island. That 2-speed economy and farmers doing well. South Island outperforming, but just not really gaining traction in the North Island. That's now starting to balance out, and we saw a bit more of an even spread there.
But the North Island
catching up.
Because your 2 major cities are in the North Island. Christchurch, third largest in the South Island. But that's important. And you saw that in the card data, right? The Kiwi Bank card data before this report.
Yeah, we did see that. I think it was for the September quarter. And it was our data showed that things were still pretty soft in terms of consumer spending, but where there was a bit of good news was in this household space, in home electronics, home contents, and furnishings. And we were looking at the volume of transactions. It was actually starting to pick up. I think it started to pick up in the middle toward the middle of this year. And then it's kind of been showing in the national statistics now. So we are seeing this pick up, and our data did predate that. Which is good.
Well, I think I'm like the perfect consumer at the moment because my wife and we went to one of those electronic stores, bought ourselves monitors and bits and pieces. I mean, I picked up a 27-inch monitor for like $160 or something, and it's curved and it's cool and all that sort of stuff. And then there's that, 60 months interest free. And I go, I'll take that as well. So I'll pay it off over the rest of my life. But, like you just get sucked into these things. And I think there's a lot of discounting going on, but I am actually hoping that they're getting traction and clearing their stock.
It does give a good sign for that Black Friday season and the whole holiday season for retail, which is really important for them. Really sets up next year. But I think it's people just bargain hunting, especially if they're thinking about going into the housing market. Maybe you want to stay a little bit liquid, but you can't avoid a sale, really.
Well, you and I were joking earlier today about 20% sales. What's the point? I'm not going there for 20%. I want 50.
But when you see a 20% sale for long enough, you're like, oh, it sounds quite cheap. I'll go in.
I think one of the why it was such a powerful read as well is because we know that retail has been one of the sectors that's probably underperformed the most during the recession, and it's probably the first real green shoot we're seeing in retail sales. All the other green shoots, like I said, have been concentrated in that external sector. So it's really, I think once you see retail turn and then also construction, right, that's when you go, okay, things are spreading, interest rate relief is filtering through the economy. So I think that's your first sign. And then you think about the fact that there is, 30% of the mortgage book re-rolling into lower rates. That should continue to build from there. So I think that kind of gave it a little bit more power, that the recovery is spreading and it's not just concentrated in one area.
I think that construction bit's important as well. Right. And we heard from one of our business managers this morning.
I don't think I was part of this conversation.
Weren't you there?
think we were hovering.
Rudy came
Oh,
in.
I wasn't part of that conversation.
Oh,
but
sorry.
tell me now. So.
Well, okay. I thought I was going to
I was
say,
like, I'm missing
here's
something.
a layup. I thought you. So
you got to tell me now.
One of our business managers came in and introduced a new recruit. We poached him from one of those Australian banks, and he's joined us. And they were saying that there are some green shoots in construction, right, from a few of our businesses there. Were you there, or was I?
Look toward this way.
I think I went back to the weekly.
Yeah, they were saying activity was starting to pick up, which is really good.
I mean, like, talk about green shoots, right? Retail, construction, the two worst.
Yeah, exactly.
Yeah.
But yeah, they're starting to see green shoots here. I mean, we were always expecting.
He was saying scaffolding, wasn't he? He said scaffolding and a few other things, which is like one of those. Okay, if scaffolding is picking up, then clearly there's
obviously activity picking up.
They're not just putting scaffolding around
for nothing.
Yeah, nothing. There's something in the middle.
Yeah,
which all just adds to the case that 225, does look like the bottom. We think it is. We hope it is.
I hope it is. Yeah.
And we just want to keep seeing more of these green shoots and data across all areas of the economy, and then we should be well away into the recovery into next year, which I know if you probably go back a whole year today and watch the episode we did like a year ago,
we
probably were saying the same thing, but I think you said it at the beginning, MJ, that, conditions now being in stimulus settings with interest rates there, we're in a much better place for this recovery to actually take away.
Actually, we were expecting this year to be a year of two halves, and that the first half would be kind of shaky. Let's just not talk about the magnitude of this recovery we're talking about.
Yeah, that's right.
But the direction is there. It looks like September quarter, the economy picked up, and with the kind of indicators we're seeing now and hope, the Kiwi is lower, so that should be good for our tourism. It also sets up a good fourth quarter, a good way to end 2025. So I think the second half recovery is playing out. Maybe just not as strong as we had forecast last year, but the direction is there.
Yeah. I can't wait to come back in February and, we would have seen third quarter GDP data. We would have seen another inflation report, seen another of, all the major data releases, right? And I think we will just have a better handle as to whether these green shoots have actually taken hold this time.
Yeah.
Because they keep dying away, don't they?
Yeah. That's really the big concern is we see green shoots, they blossom over summer, but then they kind of die away in the winter. But this time around, the big difference, if we were to compare the 2 years, is that interest rates are at much better levels for more risk-taking in terms of investment, in terms of consumption. The housing market's in a better place.
Yeah.
I
think we're going to have to change our vocabulary a bit, because a few business owners have kind of gone back to me and said, stop mentioning green shoots. I do not want to hear about green shoots again. I'm like, okay, I'll call it something else, like recovery or whatever. And like, yes, please, something else, not green shoots.
All right, got to start brainstorming synonyms.
We do, yeah.
Okay, well, I think that wraps us up for this episode, wraps up the last monetary policy decision for 2025. Like we've said, we think we're pretty much at the bottom here. We're really looking forward to seeing how the economy still plays out over the summer period. But really, we're coming back to February with our eyes really on the data. We've got a new governor starting today as of recording, and Dr. Anna Bremen will be there at the February meeting. Hopefully it's just an easy on-hold decision if these green shoots take hold. We haven't brainstormed yet. Next episode, there will be no mention of green shoots. We'll find a different word.
We
promise. But that's pretty much it for this week. Make sure, as always, to like, follow, and subscribe, and we'll catch you in the next one. You've been tuned into This is Kiwi Economics, Markets, Mystics, and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwi Bank.